This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
Next week, we have the quarterly refunding announcement. We can talk about that in a little bit and what the Treasury might do with respect to bills versus duration. That'll be an important driver for next week. And next week, we have the Fed as well. And as for the Fed, they're a blackout now. But last week, Powell spoke and, really intonated that while it's unlikely that the Fed is going to be raising rates, certainly not in November. The odds are basically zero. And even for December, despite better data, the odds are, very low, sub 25%. There is, a view potentially at the Fed that maybe more needs to be done. And Powell doesn't believe that we are necessarily in restricted territory. And if we continue to get strong economic data, which tomorrow will be another tell on that, we have GDP tomorrow. Atlanta Fed GDP estimate is 5.4% for the third quarter. Consensus is looking for 4.5%. So if we continue to get this strong data, and then we have the PCE on Friday, the Fed is going to be in a very tough situation here where they should be doing more in order to slow this economy down, and they're not. And so the markets are grappling.
So much of that GDP print tomorrow, though, is inclusive of government spending. So we've got to parse that out. Is PCE of interest to you, which comes out on Friday? I'm always looking at jobless claims on Thursday morning, but in particular, kind of flat to rising inflation is again, a nice tailwind for yields, and not that they need it with geopolitical risk and just rising risk premium. But what do you think is the deal there in regards to the PCE? What are you expecting?
Tomorrow is claims. That will be important. And PCE is always important. And there's been a trend of late where core PCE has, shown some improvement. The issue is that core services PCE has really not shown much improvement. And so that's core services ex housing. And that data point on the CPI was actually a very concerning figure. And it was up towards 0.61% month on month. It was the third month in a row of gains on a sequential basis. So I think there is hope that from the Fed that they will see more momentum on this core services ex housing inflation print. But to the extent that does not happen, that is a very big concern because we are not seeing a slowdown in the labor market, commensurate with a return of inflation back down to 2%. Because the labor market, the strength of the labor market and wages is the biggest driver of core services ex housing inflation. And if we don't slow the labor market and we don't slow wages, we're really not going to get that figure back down to 2%. And I think there was some discussion today about UAW and Ford coming to an agreement. So the idea there is a 30% all-in rise in wages and benefits over a 4-year period. So that's, 7.5% a year gains versus a 2% inflation. We're just not going to get there with that kind of labor market momentum. And then, you'll say, oh, well, unionized labor force is small and what have you. But we've seen this time and again, right? Kaiser healthcare workers, 6% wage increase. Even the federal government next year is seeing a 5.2% wage increase. And as more wage gains are seen by unions, more people are going to join unions, and more people are going to want others to represent them, and are going to continue to look for wage gains that help keep up with inflation. So I've said this before, but in order to break that cycle of wages, we need to get layoffs. And in order to get layoffs, company CEOs need to be upset about their stock prices. And stock prices falling forces layoffs. And so if we don't get stock, look, we're starting to see stock prices fall, right? IWMs are making a low for the year. Many,
it's down 5% for that.
Many sectors that are away from big tech and away from energy are starting to, see some layoffs. But where the biggest employers, whether it's the Amazons or Walmarts or whatnot, they're not there yet. So, but more stock price underperformance will lead CEOs to start making decisions about payroll for employment for next year. And that's how you kick off this cycle of stocks down means job cuts, which hits the wage market, which is how you bring core services inflation back down to 2%. So that's a dicey setup for equities, in that environment.
Because it's slowly then all at once. Once they start to see the unemployment, the WARN notices turn into layoffs, then the companies that are small to mid-size that are kind of hanging in there but suffering, they're waiting for cover to lay off, they come all on at the same time. So it does tend to be a trickle and then a flood. So there are estimates as far as when that's going to start to hit. Could be end of quarter or beginning of next year, but it seems to be very, very close. But we haven't seen any indication of it yet. So on recession risk, what do you look for? And I know we got a question mark. I see that. Don't worry about it. I'm going to answer that. But in regards to recession risk, what do you look for besides uninversion of the yield curve and rising employment? Besides those two big.
Yeah. Look, I mean, I think what we're getting is, look, after a 4.5% GDP print for the third quarter, the idea that we're near recession, I think is, not, we're not there, right? We're whether or not we're close or not, and we could argue about that. But there certainly are areas of the economy that are more sensitive to the rise in rates than not. And so the question is, are we going to have these rolling recessions where certain sectors go into recession, other sectors are doing well, and then as those fall down, other ones come back up again, and so the broad economy doesn't fall? Or are we going to get a something that's much nastier where credit spreads start to widen out and companies start to struggle? We get these layoffs. Ultimately, I think we are going to get the latter case. I mean, the idea that we could, have an economy that sees 500 plus basis points of interest rate hikes, off zero, and continued quantitative tightening, and not see a more protracted slowdown in the economy. I think and get inflation down to 2%. I think that's not going to happen. But it's taking longer than anybody thought. And that's because, as we discussed, corporates and for the most part, and households have termed out their debt for, during COVID at low rates for long duration. And so that window, that maturity window is further than it normally would be. And so from a high yield perspective, there'll be some maturities next year, but really the wall doesn't really kick off until 2025 and 2026. As far as households are concerned, look, I mean, people who have a low mortgage, they're locked in, they're not moving anywhere. And so what we have is a housing market that's very bifurcated, where people who have homes with good mortgages are not going anywhere. People still want, but people who have jobs without homes can't find homes. And so I think you probably saw today, new home sales in the US hit an 18-month high this month. So again, is the housing market slow or not slow? I mean, it's hard to, really argue that housing is leading us into a recession when we're printing, new highs in home sales. So I think it's more likely that we're going to see this turn in the data, in the first quarter of next year. I mean, PMIs, service sector PMIs, in the low 50s. I think that'll, gradually roll over. And if energy prices stay firm, amidst the geopolitical, there's going to be consumer wallet share that moves to energy and away from other things. So that's a headwind. But look, ultimately, calling recession or not, I mean, I think is, it's fun to talk about, but whether or not it matters for making money, I don't really think it really matters. The Fed's mandate is employment and inflation. And in order to bring inflation back down to target, they need to get the unemployment rate. And so that's where we're going.
Watch the full episode and subscribe to LaDuc Trading YouTube channel for more macro to micro videos and other content.